I think we are. I think we're going to get started here. It's 1:01 here Central Time. Welcome everybody. It's February 18th. It's actually a market holiday, President's Day. So happy President's Day. Can I, before I get going here and start talking, can I just get a confirm? Maybe Jeremy or somebody just let me know. Just jump in on the chat and make sure we got good audio. So I can. All right, great. Thanks, Karen. All right, welcome. Again, it's President's Day, and here in Chicago, it's kind of cloudy but not too cold. I think it's like 38 degrees out there. So, you know, here in the Northern Hemisphere, especially in Chicago, every year, I just got weird feedback out of my computer. Every year about this time, our family is obsessed, actually me, with the increasing daylight that we get every day. And I just, FYI, we are getting here in Chicago 2 minutes and 40 seconds of additional daylight per day. So for all of you that are stuck here in the cold and the dark, spring's coming. I'm here to tell you, spring's on its way. So hang in there with me. All right. Today we're going to cover risk reversals, and I'm going to kind of go over this as an approach not only to as a sort of a portfolio management entry approach. It's kind of a little different twist than some of the other stuff you've had. So hopefully you'll enjoy it and get some use out of it. So anyway, happy President's Day. There it is. There's the White House. It looks nice there, wherever that was taken. It sure looks nice. Doesn't look like my lawn, that's for sure. Now, in light of President's Day, we have to have presidential trivia. So I got some trivia questions here before we really get started. This is the important stuff. Abraham Lincoln was the tallest president at 6'4". The shortest was James Madison, 5 foot. That's supposed to be 5'4". I messed up on that. Here's one of my favorites. Andrew Jackson's pet parrot had to be removed from his funeral because it would not stop cursing. So for everybody that's got a parrot, make sure you train it properly. Thomas Jefferson, George Washington, and John Adams were all avid marble players. I used to play marbles when I was a kid. I gave it up. Maybe that'll make a comeback. And finally, Ulysses Grant once got a speeding ticket for riding his horse too fast. So these are all little presidential trivia I got. I thought they were kind of cool. There's actually a whole bunch more, but these were really like 4 or 5 of my favorites. So who is Obama googling with his WE? What's WE? What Y/E? Obama's playing golf this weekend in Florida, I think, and the rest of his family's in Colorado skiing. So that's what's happening. Yeah, he's hitting the ball. So I'm not sure who he's playing with. He's playing with Tiger Woods. That's right. I heard he was playing with Tiger. So anyway, that's the presidential trivia. So we'll move along here. I've got the legal disclaimer. I know Discover Options and as a representative here of PLE Capital, I have to, remind everybody this is all for educational purposes only. Please consult with your highly paid attorney for tax professional and advisor for any other stuff. So, all right, let's get started here. And first things first, the synthetic. A risk reversal, okay? A reversal, all these strategies that we're going to go over today, and there's really only a couple, and this may be review for some, but they're known as synthetics. Synthetics. And what we mean by a synthetic is a combination of stock or options, a call or a put, to create the same. Okay, we can use calls and we can use puts to create stock. Effectively, the exact thing as having a stock. Okay, so we can do that. That's a synthetic. It's a synthetic stock. For example, we can create a synthetic call. The way we do that is we buy a put and we buy stock. Okay, that in itself, and we're going to toggle this a little bit. I'm going to kind of move from the PowerPoint with some of these ideas, and then I'm going to jump on over to the software. I'm going to model a couple of these out here. We'll kind of play around with the software too, so we'll be able to see how these look. But we can create that synthetic call by buying a put, buying the stock. Okay, that combination is the same thing as if we went out and just bought the call. Okay. Long synthetic put occurs when we buy the call and we sell the stock. So if we buy a call and sell stock, that is the same thing as just buying a put. All right, and then as we said earlier, we can create the long stock, in this case a synthetic stock. We would buy a call and sell a put. Okay, that action, those two things create a long stock. And we can create shorts. The flip side of this is the shorts. So the short synthetic call would be selling the put, buying the stock, or selling the stock. Okay, that would create the short synthetic call. So you just kind of flip over all the signs. You can get the longs and you get the shorts. You can mix and match all different ways. So those are the synthetics. Just as a point of reference, we don't really use this term that much off the trading floor. We used to use this on the trading floor a lot, but a long call and a short put, that combination is called a reversal. That's called a reversal, so hence we get the name risk reversal. And the short stock is equal to let me step back. Buying a put and selling a call is known as a conversion. It's known as a conversion. That creates a short stock position. So you got a reversal, you got a conversion. Okay, I don't know if it's really that big of a deal to know those terms. They're terms that for those of you, maybe if they're on the floor or guys who trade the floor, those were terms that we use on the floor all the time. And you carry over somewhat to some of the terminology like risk reversal. Okay. So let's go into the risk reversal here, and then we'll go over and we'll model this out in the on the software. The risk reversal again is we buy a call and we sell a put. Now, if we buy a call and sell a put at the same strike, that is sort of traditional reversal. Okay, that creates a pure synthetic stock position. What the risk reversal does is we buy an out-of-the-money call, and we would tend to sell an out-of-the-money put. Okay, so now we have a situation where the call and the put are at different strikes, hence the term risk reversal, risk. Okay, what do we have? We have a long synthetic stock, sort of. Okay, it's sort of synthetic. It's long, but again, we're going to graph this out, and you'll see there's a flatness in the graph that occurs that's between the two strikes. Where's the risk? Well, the risk is in the separation of strikes, the long and the short put. That's what they call the risk there, is the risk and the risk reversal. Whether or not it's real risk monetarily or price-wise, that's debatable, but the risk is the fact simply that they're separated out. They're different strikes. Okay, so let's do this. I'm going to jump over here, and we're on this new webinar thing, which is actually pretty sweet, but I'm gonna make sure I get you guys to look at my thing because we're still getting used. You should see my software right now. There should be OptionVue. Okay, and you see my code screen here. Obviously, this is all from last Friday, so there's nothing really happening, but let's jump over here to IBM. Okay, I've highlighted IBM. Usually I use Apple, but we're always using Apple, so let's go with, let's do IBM today. I'm going to open up the matrix, and for those of you that are familiar with OptionVue software, this is all very familiar. Real quickly, the top you can see the call matrix. You can see the calls here on the left margin, and the puts here below on the left margin are underneath here. We have market price. We have MIV, which is the midpoint of the implied volatility, and I have gamma, and I don't know why I have that up. Let me get rid of that here. There we go. And the deltas here and the prices. So anyways, we can see IBM's trading at 200, okay, $298, $200.98. Let's come up with it real quickly. Let's make a typical reversal. A typical reversal is this, okay? We buy a call and we sell the put, okay? That's a reversal. That creates a synthetic stock, okay? And if we map this out or we graph this out, you can see the deltas here. What's 100 shares of stock? What's the delta of 100 shares of stock? It's 100. Remember, each option represents potentially 100 shares. So if we got one call, sell one put, like magic, we've got 100 deltas, okay? There's a little, we're off by one, but that's just having to do with the way the system rounds deltas. So, and there you have it. There's our delta. There's our stocks. It's a straight stock. It's exactly as if we went out and bought IBM, okay? There's no difference there with that. That's a traditional reversal. Now, let's go ahead and do the risk reversal. The risk reversal is when we go ahead and we go out of the money. So instead of buying the 200 calls, the at the monies, let's go ahead and, you know what, let's buy the 205. We might have to move to April because we don't have a whole lot of choice here in March, but let's go ahead and buy the 205 call, okay? And then let's go ahead, and before we had the 200 put, okay, that was the at the money, let's go down here and sell the 195 put. There we go. A risk reversal, okay? Out of the money call, out of the money put. What do we got here in terms of, and you know what, I forgot to go over the Greeks on the other one. I'll go back. You can see that our delta here was less in this case than it was for the straight reversal. The straight reversal, we had 100 delta, okay? It was essentially one share of stock. In the other one, the gamma would have been pretty close to zero. The theta would have been pretty close to zero in their straight reversal. And the vega would have been very close to zero. You can see hopefully you guys can all see the software right now. All right, and we're going to start over. Hopefully this will work this time. All right, clearing the trade. We are in IBM. We are in IBM, and this is my desktop. And Jeremy, if I'm having a problem, if you're not seeing this, text me, okay, and let me know. But otherwise, I'm gonna assume we're good. I'm going to open up the matrix, and we have the matrix for IBM. And again, here's your calls on top, puts on bottom. The first thing I did before is I modeled a straight reversal. A straight reversal. Okay, a reversal, remember, is a long call and a short put. A long call and a short put. Let's try it. We got a long call and a short put at the same strike. This is a synthetic stock, okay? No difference than if we went out and bought a stock in terms of its performance, in terms of its, there's going to be some pricing differences. You can see down here. There's our delta, same as long stock, 100 shares. 100 shares of stock, one call, one short, one put, represents 100 shares. There's our deltas. You can see our gamma effectively 0, theta effectively 0, and vega effectively 0. Let's take a look at the picture, and there you have it. That's a synthetic lowing stock. That is a reversal. Okay. Now, what I'm going to do here is I'm going to switch this out and try and create a risk reversal. Okay. And all I'm going to do is I'm going to change these strikes to this. All right. We now have the out of the money call over long, and we now have the short out of the money put. Okay, hence risk reversal. So what do we have here? Let's take a look at, let's just look at our, basically, the delta we see is less. Okay, before on the regular reversal it was 100 because that's basically exactly the same thing as being long 100 shares of stock. Here we're only long 46 deltas. Why are we only long 46 deltas? Because we're long out of the money calls, and you can see these 28 deltas, and we're short the 195 puts, which are a little bit out of the money, and you can see that those have 18. You add them up together and essentially come up 46. Okay, we have a little long gamma. Okay, again, just to repeat what I had said before. I know nobody saw it, so Jesus, just like talking to my teenage son. You know, I'll go through something, I'll explain it to him. The difference between them, you guys had technical problems. He'll sit there and look right in my eye, and I'll sit there and explain something to him, and then he'll be like, "Dad, what did you say?" He'll walk away, and he didn't hear anything. So I'm getting good practice at talking to my teenager, repeating myself. So we got the gamma, slightly long gamma. Again, the closer the strike is to the at the money, the greater effect that's going to have on the grease. In this case, the calls are slightly closer to the at the money. About 201 is about at the money, so that makes these calls a little bit closer. So that's causing this gamma to be slightly positive. Okay, theta is a little, essentially, I mean, this is, you know, almost noise here, but you could maybe make the argument that there's a little bit of collecting a little theta here because our puts are a little more expensive than our calls. Even though they're a little bit further out of the money, they have more extrinsic value in them, so they're going to decay quicker. Maybe the rate of decay is just making up for that slightly higher price, but this is tiny. And then we have a little long vega. So there you have that. Here's the picture. I'm going to try to move this through a little bit. I know I killed some time. This is the risk reversal. Here's our long call, and here's our short put strike. So we can see in the middle, and this is just a parity graph, folks. I just got rid of all the lines to make it a little easier. This is if the stock closes. This is an expiration if the stock closes between the two strikes. Okay, all we're going to do is collect, in this case, $6 after commission. Okay, if the stock closes above 205, okay, we've got basically a long call that we can exercise. If the stock closes below 195, we've got a short put that we're going to get assigned on, and that's put. Okay, so this is the risk reversal. The risk is the center section here that, you know, you have risk and sense of exposure into the market, I guess. You can move these strikes back and forth. Okay, you can adjust these. I picked those two strikes. You could certainly go and do all sorts of stuff. It's kind of a slick strategy. If you're trying to, you know, use it as a portfolio management tool. Okay, we do a lot of put selling stuff to take, you know, stock ownership. But, you know, inevitably, if you're just short puts, what happens is you end up, if the stock runs, you end up with your cash. You keep, the put goes out worthless, and you end up with money, but you don't ever take the stock. In this particular instance, you got this long call. So if you got a stock that really takes off and starts running up, you can exercise your call. Okay, that's what makes this kind of cool. Now the trade-off is you get nothing if the stock, you know, closes below your long call. You don't make any money here, really. And it doesn't really do anything to lower your cost basis if you get assigned on your put. Okay, so you know, there's always a trade-off in these strategies, and this is cool because you do get the stock if it runs hard, but if it doesn't, or if it goes down, you're giving up yield. If it settles between the two strikes, you don't collect any money basically. And if it breaks hard, your cost basis is really going to be that strike price. Okay, you have no extra income to sort of lower your cost basis. Okay, that's that. Now I'm going to try to go back and see if I can, all right, okay. I'm going to try to go back and see if I can get, well, I'm missing a tab, Jeremy. I can't find my PowerPoint. It's gone. I'm going to try this. Okay, there we go. Thank you. Now I have it back. Okay, so I'm going to toggle here and get back to my PowerPoint. Hopefully we can get this working again. There's the risk reversal. Why use it? I think everybody hopefully can see this now. I am sorry about all those technical problems. It's President's Day though, so you know we're on vacation mode. Don't blame it on that. Low out-of-pocket way to potentially take delivery of stock or underlying. So, you know, again, I mean, you could go out and buy call, or you could maybe look at a risk reversal. So it's a cool way to potentially take delivery of a stock or an underlying. And let me just point one thing out. I'm using IBM. We talk about stocks. We deal in ETFs a lot. This is a strategy that you could use on anything. A commodity, you could use it on futures. Whatever there's options on, and whenever there's a deliverable underlying, this is a strategy that works. In the world of commodities, sometimes they call this the collar. They flip it around a little bit, but nonetheless, it's long call, short put in this one. The margin on the short put, so be careful. You got a short put out there, even though it looks like if you buy a call for $1 and you sell a put for $1, you're out of pocket $0. Yeah, that's true. But you still got to put up the margin on the short put, okay? And your broker will charge you, so you're going to have that secured in your account, okay? And we take stock if at expiration the stock settles below the put strike, okay, or the call of the call strike. So we have two potential places where we would take the stock. Okay, so that's really, I think, the usefulness of the risk reversal for us. All right, let's peel the onion here a little bit. Net price, again, we pointed out the net price will depend on the width of the strikes and the volatility skew. Okay, the width of the strikes and the volatility skew. If I go further out of the money, I can make my calls much less costly. Okay, that's going to lower the amount I pay for the call. If I go not so far out of the money on the put, I can collect more money on the put, so I could actually have a net credit. If I go further out of the money on the put, I'm going to collect less on the put, so I may not have as much credit, or I may have no credit at all. So that's going to affect it. The volatility skew affects it. Puts in the equity world always trade at a higher implied volatility. Okay, so if I'm going 10 points out of the money on each one, I'll show this here. I kind of get nervous to go back and forth on my thing now, but if I go 10 points out of the money on the call and 10 points out of the money in the put, in 99% of the stocks, the put's going to be more expensive. I'm going to collect more money on the put than what I have to pay on the stock. That's due to the vertical skew in the options. And it says puts tend to be more expensive. The Greeks, we showed long delta, okay? Depending on the strike selection, it'll be long delta. And the other Greeks are based sort of on the strike selection and relative relationships to each other. Okay, so it's always going to be long delta on the risk reversal because we're always going to be long call, short put. But the other Greeks, we showed, the gamma, the vega, the theta, all that, will sort of depend on the relationship not only to each other, but on the relationship to the at-the-money. Okay? All right. Hopefully that's clear. And if anybody's got any questions, just shoot them into the chat. I have the chat here. I can see the chat now while I'm doing the PowerPoint. I cannot see the chat when I see my desktop. So, but right now I do have the chat up. So, all right, I'm going to move the slide here. Risk conversion. Okay, this is the risk conversion. This is what I call a collar or part of a collar. It's a collar if you're long stock. Okay, if you're long the stock, this is what most managers or most if you read an article and stuff, they would call a collar. The short call long put portion of it is what we would refer to as the conversion or the synthetic short stock. Let me just read here. I'm getting a couple of comments about how I need some technical help, I'm sure. Capella, you're not allowed to play with the computer anymore. Hold on 1 minute. We missed the last 4. Yeah. Go back to when you did the IBM 25195 put. Would you use spreads to control margin risk? Okay, great question. Would you use spreads to control margin and risk? That's something that we can use. In fact, I get into that here at the very end. How you can, for example, on the short put, and we'll model this out. Below the short put, so in the IBM example, I had the 195 put. We could go and buy a cheaper put underneath, like the 190 put or the 185 put or whatever, to control margin and control the risk. So, and we can do the same thing on the call, in the case of the collar here, because we sell the call. You could go out and buy like a further out of the money call. They call that a slingshot. Yes, that's a great point. I'm going to get on that. There's certainly a cost to that. Okay, there's a cost to that. Whenever you go out and buy options, you got to pay for them, and that's going to, you got to take that into your overall strategy here. But yes, you definitely can do that. Risk conversion or collar. So in that one, we're going to sell the call. Okay, again, out of the money typically. And buy a put, usually out of the money. The reason I say usually in the case of the collars, because this is a strategy that's used against long stock generally, and it's a hedging strategy. It's a strategy where people are nervous of the market. They want to really lock in a certain price range. So a more conservative approach might sell like even an at the money call, or you can sell an in the money call if you want. But generally the way I'm going to talk about it today is an out of the money sort of call and an out of the money put. And again, at different strikes, like we said. Remember the regular conversion that we had initially was short call, long put at the same strike. Okay, there's a pure synthetic short stock. With the risk conversion, we're talking about a short call and a long put at different strikes, out of the money call, out of the money put. All right, let me go forward here. Okay, why use it? I'm not sure. You would use it to protect your stock holding. That's the most common reason that people would do something like this. It tends to keep exposure within the price range by the call and the put placement. Not tends, it will keep your placement. Okay, and again, strikes will affect cost, and we'll show that here in a second. I jump over to my PowerPoint. I'm afraid to go to the PowerPoint. I'm afraid to go to the software. Generally not a standalone strategy. Okay, generally we're not selling calls and buying puts. Okay, that's typically not a strategy that somebody would normally use by itself. The short call can be prohibitively expensive, and I don't think you can even do that in most IRA accounts anyway. But it generally is a strategy that's tied in with somebody who already has ownership of the stock. All right, Jeremy. If I mess this up, text me right away. But I'm going to hit desktop, and then I'm going to show my screen here. Desktop, and there it is. I'm hopeful that everyone is there. I'm waiting for my text machine to start clicking here, but this is what I did last time, I thought. All right, I'm going to assume here that I'm good because I haven't heard from anybody. We're back in IBM. Okay, and if you can't see this, just use the mind here. This would be a mind exercise. I tell my kids, mind exercises. We're back in IBM, and I am going to create a conversion, a straight conversion that we talked about. Now, we're going to use a 200 strike again, like we did before. Short 1, 200 call, long 200 put. Okay. Exactly the opposite of the reversal that we had. And here's what we have. Short 100 deltas. A gamma is effectively, these are essentially zeros. These theoretically are, oh geez, I'm getting a text now. You gotta be kidding. Wait a minute. All still, okay, I got a good, that's a good one. All right. Okay, so we have a synthetic short here. Forget about these gamma, theta, vega. This is noise. This is just rounding and in the model doing noise. Let's take a picture of it. This is what it looks like. There's your short stock. Okay, that's a short stock. If I were to do this, let me just do this real quick. Clear this and sell 100 shares of stock. Analyze it. It's the same. This is the same as the other. There's a difference here just in terms of the scaling of it, but that's, you can see the thing. It's the same as a short stock. Okay, it's the same trade. All right, so let's get rid of that, and let's go ahead and let's put on a risk conversion now. Let's use the same strikes that we used in the reversal. We'll stick with March because we're only going to go a little bit out of the money. And whoops, I got to buy one, right? Yeah. Okay. So there's our risk conversion. There's our risk conversion. Okay, we're short 1, 205 call, and we're long 1, 195 put. If you notice, these Greeks are basically the opposite of the Greeks that we had on the risk reversal. We're now short 46 deltas. Okay, we're now short some gamma. Okay, again, this one's a little bit closer to the at the money. We're now short some, short the theta. We're paying it out a little tiny bit. Again, these puts are a little more expensive maybe. And then the vega. Okay, this is exactly the opposite. Okay, and there's your picture. Okay, it's the same. It's the mirror image. All right, it's the mirror image. Okay, so you can see here that if the stock closes above 205, we're going to have to deliver the underlying at that price. Okay, if the stock closes below 195, we're long those puts and we get to exercise. We get to exercise. Now, that's the risk conversion. It's not, again, not typical of a standalone strategy. It's more typical when you have it wrapped with some stock. So I'm an investor and I've got 100 shares of IBM and I'm nervous about the market. Okay. So what I can do is I can go ahead and sell these 205 calls. And again, I'm long the stock, so I don't have to worry about any kind of crazy margin. It's a covered call. And I can go ahead and buy these 195 puts as protection. So what I have done essentially is created a boundary for my exposure in the underlying stock. Whoops. And guess what? There you have it. Okay. This is essentially a call spread. What we have done is created the same thing as a call spread, and I've shown this in the past. Okay. But what we have is upside limited. Okay, because we're short the call, you can see that we're limited on the upside by the strike price of a call. Okay, and we're limited on the downside by the put. Okay, so there's a 205 basically right there, and there's the 195 right there. Okay, it's the same as a. If I were to go out and buy a 205, this is an aside, I won't do this, I've done this before, but if you go out and buy a 205, 195 call spread, this is what you're going to have. Okay, so for those of you that like the strategy and think it's an interesting strategy and you don't already own the stock, you may want to just go ahead and buy the call spread and forget about putting this three-way on. It'd probably be expensive and easier to execute. Okay. So that's the idea, though, of the collar and of the risk conversion. Okay. Now I'm going to attempt to go back and tempt fate here with technology, because I have to go back. And hopefully everyone now sees my PowerPoint. Excuse me. And I'm back to the PowerPoint. So I'm going to continue here with the PowerPoint, and yeah, I'm hoping everybody sees the PowerPoint. If I don't see the PowerPoint, then I can see the chat, so somebody will yell at me. And then we can go back to the, if anybody's got any questions about any of the modeling that I may have missed or something, just let me know and I can go back. Okay, and we went through this again. It typically, for protecting the stock holdings, this is the risk conversion. It keeps exposure within a price range. Okay, we saw we're limited on the upside by the call we sell. We're limited on the downside risk by the put we buy. And the strikes, again, like the risk reversal, the selection of strikes will affect our debit or credit, as well as the implied volatilities. And we mentioned here this naked short call can have a very high margin. Okay, so that's why like I said, I don't think you can even do it. I'm 90% sure you cannot do a naked short call in a retirement account. But even still, it's real expensive to sell calls naked. So that's that. That onion again. Net price. Again, net price is going to be simply the call credit in this case, less the put debit. Okay. It depends on the width of the strikes and the volatility skew. Okay, like we said. The puts tend to get more expensive. We know that in the world of equities, this is the world of equities that I'm talking about. This isn't commodities, okay? But in the equity world, out of the money puts are more expensive. Out of the money puts are more expensive. So you're going to end up, whenever you buy puts, 10 points out of the money. Oh, I was going to do that, wasn't I? I'll go back and show that. You're going to end up. In fact, I'll do that right now. I'm going to try to attempt this. Don't try this at home. We're highly trained professionals here, so please don't attempt this. Let me clear this out. Let's forget March. Look at April. We're at 200. Okay, there's our at the money, and there's our at the money right there. If I go 10 points out of the money, and essentially we're right here. The 90 puts are trading at 185. Okay, these are actually 11 points out of the money, essentially. If I go to the 10 calls, these are actually only 9 points out of the money. These are trading at $1.38. These are trading at $1.85. Okay, this just illustrates the vertical skew and how the puts are more expensive. You can see the MIVs here are much higher. This is an 18. This is a 13. So that just shows you that's obviously going to have a huge impact in terms of how much these strategies cost and how much if there's a credit and all that. So that's that's I just wanted to show that. All right, I'm going to go back. I'm making the attempt here. All right, I think we're okay. Okay. So for that, puts tend to be more Greeks. Short delta, again, this is going back to the risk conversion, short delta. And the other Greeks, as we had said, based on strike selection and relative relationships to each other. And then some more stuff here. The risk reversal, there is potential unlimited downside risk in the risk reversal via the short stock. So that's supposed to say the short put. Okay. So you do have unlimited downside risk. I mean, in the sense of, I guess the stock could only go to zero, so it's not theoretically unlimited, but it's could be pretty brutal. And here's to the point that that David had mentioned earlier. You can add a further out of the money put. Okay, so whatever that short strike put that we're short, you can go ahead and buy something further out of the money. All right, and that will allow you to curb some of that downside risk. And I'll go back to and we'll model one of those out here real quick. We got a couple minutes. And the risk conversion on the collar, we're capped on the upside move. We showed that, and we can add further out of the money calls. That's called a slingshot. There was a guy who invented that term. I forget. He used to be involved with Thinkorswim. I knew him very, very briefly years ago on the floor. I remember him. I can't think of his name, but really smart guy. But anyway, he came up with that term, slingshot. Let's go ahead and show that. I'll just make that quick model. I'm gonna do this again. And yes, Charles Cobble, correct. That is right. That's his name. All right. There we go. I'm back. I hope everyone can see me. If not, I will get Jeremy to tell me. So we have. Let's go ahead and let's go ahead and do. If we were to have a risk reversal, okay, out here somewhere, and I'm gonna just, this is kind of our risk reversal, like we had before. This is April. Clearly we got this. Okay, this is a concern, and ideally this is a good strategy. You have to know where you want to buy the stock and all that. You always take that into consideration. But if you're concerned about it, one strategy is to go and do this. All right, well, guess what happens? We got to pay for that put, so now we have a debit. This is a debit. Before it was basically break even. It's 289, 294. You're basically zero. So now you got a little bit of a debit here. It removes some delta. Okay, but the kicker is here. Now look at what you got. Okay, it managed to sink this curve down a little because of our cost. Okay, we still got exposure down here. This is a $10 put spread. Okay, the 185, 195 put spread. We're essentially short that. But if the world goes to heck in a handbasket, at least we have this. Okay, at least we got this. So that's there's nothing wrong with that strategy. Just know that you got to pay for it. Okay, options cost money, and it affects our yield. Let's do the same thing with the collar, except it's going to be reversed now. So now we got the stock, and we're long the put. Let's just use these, and they say we're let's try this. I can't stand selling these real close in the money calls. This is your collar, okay, or a call spread. It's your collar. This is what we got. You can see that if the stock goes on, so here we are. We put this thing on. We're nervous about the market, and so we put this thing on. We're patting ourselves on the back because we did this collar. It didn't cost us a whole lot of money. And then tomorrow IBM comes out with this new product, and the stock goes up $50. So we're screwed. We missed on a huge move. Well, you can avoid that by doing this. Okay, you buy this. Okay, so now is just the flip side of the other one. You got no participation here. Okay, we're capped here again because we got the long stock, short call. This call is now in the money, calls in the money. We're long the stock, short the call, so nothing's going on. But suddenly, this out of the money call that we bought kicks in. So essentially, we're long this call right here, and we get to participate. So that's called a slingshot. It's easier actually to do on calls because calls get cheap so quickly. You could see the drop off in these call prices as we go up here, as opposed to the puts. They tend to hold their value much more through the range of strikes. So this type of strategy on the slingshot, as Charles Cottle, tends to be a little more feasible just in terms of cost. Okay, you can buy these cheap little dinky calls here, and they could pay off huge. So, all right, let me go back here. Presentation. All right. Collar, we're capped in the upside. We just talked about all this, so there we have it. And we're in the home stretch. Oh, the risk reversal and the risk conversion are a hybrid synthetic. Okay, we talked about that. They're synthetics, but I like to think of them as hybrids because they're not true synthetics. Well, not true in terms of they're not going to mimic the underlying as a stock. Okay, they're going to have that little flattish area, and depending on how you structure it, you can really have some curves and some bumps. They can be used as an entry strategy or a hedging strategy. So the risk reversal, the buying the call, selling the put, is typical of the more of an entry strategy. Okay. Although if you're short stock, it would be a hedging strategy. Okay. And the collar, the risk conversion, is typical of more of a hedging strategy. The strike, the implied volatility in the month selection will affect risk and cost. Okay, we mentioned that. So those are the three things that really will affect it. As we didn't go out too far, we played mostly in March. We went out to April a little bit, but all that, as we move further out in time, as option prices and SKUs move, that certainly could affect the overall cost. And we can use further out of the money calls or puts to contain large movement risk. Okay, that's the slingshot, and that's going out and buying that further out of the money put in the case of the risk reversal. So I think that's all I got. I think that's the whole presentation. There it is. Thank you. I'm available here to if anybody's got any questions, I'm happy to hang here for a while. And if anybody has any questions on how to manage a slideshow with new technology, I'll be happy to answer that one as well. But this is our contact. You can reach me at Discover Options, obviously. Be happy to answer any questions there. And my other website there, PLE Capital. But this is good stuff, and there's a lot of value, I think, in these strategies. So, all right. Well, I don't hear anything. I don't see anything in the. Oh, somebody's typing. Oh, this is kind of neat. We got this. You can see when somebody's typing. Oh, thanks. Thanks for your comments. Any other ideas or suggestions? Shoot me an email at stevep@DiscoverOptions. I'm happy to. I always want to give types that are, that people want to hear. I don't want to talk about, the third derivative of gamma if nobody really wants to hear that. I want to, have stuff that the people want. So if you got any ideas, or just shoot me an email, and I can certainly bring that to the next webinar. All right, folks. Well, I am going to. I guess I'll sign off if there's. We got some stuff here. Good. Well, I'll sign off here. I'm going to go and calculate what time the sun rises and sun sets tomorrow here in Chicago. We probably won't see it because it'll be cloudy, but anyway, I hope everyone has a great rest of the President's Day, and we will talk to you soon. Thanks.